And standing by with his calculator live at the DeGroote School of Business today, Nick Bontis joins us now. Hello, Nick.
Hi, Connie. How are you?
I'm fine. I need a quick refresher course, though. 101 on the strategy behind lowering interest rates and its connection to the dollar.
Well, we're trying to keep inflation under control. You got to imagine for the last 2 months, we've had a tremendous amount of euphoria. The media, there's so much buzz in the newspaper about our high Canadian dollar. Lots of people have been shopping. And the good news is not only have been people shopping in the U.S., going down to Buffalo on the weekend, but people have been shopping locally as well. So it's boosted up our economy. And a lot of retailers have been able to cut prices down. So because the retailers are cutting prices down on, fresh fruit and electronic devices, that's keeping inflation in check. And the other side to this, of course, is on investment. As an individual, you have a choice. You can invest in income-generating vehicles or equity capital vehicles. And because interest rates are low, what happens now is a lot of people are going to migrate some of their excess dollars into investment vehicles like the stock market or mutual funds or what have you. So those are primarily the big changes that we're seeing.
Okay, let's talk more about the downside to the strategy, though, of lowering interest rates. Who's going to hurt as a result of this?
Yeah. Well, on the business side, there'll be increase in terms of capital investment because with lower interest rates, you can imagine large corporations can get bigger loans to build big factories, so that's good news. On the individual side, it might be a little nerve-wracking because when interest rates go down, there's a perception from individuals to increase consumption. So they start shopping more, they'll maybe get a new house with a mortgage and they'll try to consume more debt. And what ends up happening, of course, is they might get into a little bit of debt trouble. They think interest rates are low, so they think their credit card bill is not going to be so high. And just a warning to everybody, when you're doing some shopping in Buffalo and you're paying with a credit card, you might think the interest rate is low, but you're not going to get the exact currency exchange that you see in the newspaper or on TV because the credit card companies take a couple of percentage points away off of that. So you got to be careful as a consumer.
Okay, speaking of debt, Nick, how will the situation south of the border and predictions of an outright recession there play into this scenario?
Well, we know that the U.S. economy is not doing too well. Even though the Canadian dollar has appreciated 18% in the calendar year, the U.S. currency has done poorly against all the other major currencies as well, especially the euro. We know that the credit crunch in terms of the subprime mortgage collapse was significant, cost billions and billions of dollars of profit in very large corporations. So the stock market's getting a hit, the currency is taking a hit, and the reality of the situation is people are predicting a recession in the U.S. I don't think we're going to hit a recession in the U.S. I think fundamentals are a little stronger than that. The little positive news in all of this is for Canadian exporters, of course. Now with the Canadian dollar slowly coming down to par, it's not going to be such a big challenge for our Canadian manufacturing sector to be as competitive as they were when it was at $1.10. That was pretty scary to sell back to the U.S. marketplace. So there's pros and cons, but at the end of the day, the Canadian government would be wise right now to really consider pegging our dollar to the American dollar because I don't know if we're going to be up above a dollar par much longer.
Well, Nick, let's see if they'll listen to you. Thanks for that interest rate primer. Nick Bontis live at the DeGroote School of Business.
Thank you.